Everywhere you look, the world is running on chips. From AI servers powering ChatGPT to the battery systems driving electric vehicles, semiconductors are the backbone of modern progress. But not all chips are created equal. Some handle logic, others store memory, and a small group quietly controls how power flows through everything. This corner of the semiconductor world doesn't make headlines like NVIDIA or TSMC, but it's just as critical, because without efficient power management, none of the technology we rely on today would even function. And within that niche, one company is pushing the boundaries, developing chips that make energy move faster, cooler, and far more efficiently. The name of that company is Navitas. It's a small cap stock that's been gaining serious traction and quietly landing partnerships across the EV, solar, and AI data center markets. So in this Pinehold stock deep dive, we're breaking down everything you need to know about this emerging semiconductor player, and whether it deserves a spot on your radar. Here's what we'll cover. A clear overview of the company, what it does, how it makes money, and where it fits into the semiconductor landscape. Its core technologies, including materials like GaN and SiC, and how they could reshape the energy efficiency of the modern world. A look at the market opportunity and competitive position within the rapidly growing power semiconductor industry. A full fundamental breakdown, revenue growth, margins, inside ownership, and the risks behind its current valuation. And finally, our investment thesis and verdict, whether this company is a speculative bet or a long-term hold in a semiconductor revolution. So let's dive in and uncover the story behind one of the most intriguing power semiconductor stocks on the market today. Alright, let's start with a quick look at the company behind the ticker, Navitas Semiconductor, trading under NVTS on the NASDAQ. Navitas is a power semiconductor company based in Torrance, California, founded back in 2014 by Gene Sheridan, who still leads the company today as CEO. They operate at the intersection of technology and energy efficiency, and their mission is simple but ambitious, to power the world's transition to sustainable electrification. So what do they actually do? Navitas designs and develops next-generation power semiconductors built on gallium nitride, known as GaN, and silicon carbide, known as SiC. These materials outperform traditional silicon chips by being far more efficient, faster, and cooler, literally. Their GaNFast power ICs combine multiple circuits, power, drive, control, and protection, all into a single chip. This makes designs simpler, reduces energy loss, and boosts performance. Meanwhile, their GeneSiC platform focuses on SiC chips used in high-voltage, high-power systems like electric vehicles, renewable energy, and AI data centers. In short, Navitas chips are helping power the world's shift to sustainable electrification, from EV drivetrains and solar inverters to the massive server farms driving today's AI boom. Now here's where it gets interesting. Navitas is among the first to commercialize monolithic GaN power ICs, packing multiple circuit functions into one device. Their acquisition of GeneSiC Semiconductor gave them full coverage from low-voltage consumer devices to high-voltage industrial applications. They claim their technology delivers up to 100 times faster switching speeds and up to 40% energy savings compared to traditional silicon chips. They're now targeting AI data centers, introducing 800-volt DC power solutions that help reduce energy losses in GPU-heavy systems. And they're already working with top global brands in EV, solar, data centers, and consumer electronics. With operations across North America, Europe, and Asia, Navitas is scaling fast, and it's competing in a world band-gap semiconductor market projected to exceed $20 billion by 2030. That positions Navitas as one of the pure-play leaders in power efficiency, a company at the center of the energy revolution powering the modern world. Now, let's take a look at the stock. As of October 23rd, 2025, here's a quick snapshot of Navitas Semiconductor's stock performance and key metrics. The stock is currently trading around $13.61 per share, giving the company a market capitalization of roughly $2.9 billion. When you factor in debt and cash, the enterprise value sits at about $2.7 billion. There are approximately 213 million shares outstanding, with a public float of about 185 million. Insiders own just over 12%, while institutions hold over around 40% of the total shares. Now, here's where things get interesting. Over the past year, the stock has skyrocketed, climbing more than 400%. That kind of move is rare and shows how much enthusiasm has built around Navitas and its potential in the power semiconductor space. But with big moves comes volatility. The company's 5-year beta sits around 3, meaning the stock is roughly 3 times as volatile as the broader market. Average daily trading volume is high, about 75 million shares, and short interest is also elevated, with nearly 26% of the float betting against the stock. Navitas doesn't pay a dividend, so this is a pure growth play. And despite the massive run-up, the analyst consensus is still marked as a buy, though the average price target sits around $5.50, well below where shares currently stand. In other words, Navitas has re-rated sharply over the past year, roughly a 4 times increase, but it still carries a high turnover, high short activity, and valuation that reflects strong future expectations rather than current profitability. Diving into the fundamentals, how Navitas looks under the hood financially, starting with the income statement. Over the trailing 12 months, Navitas generated about $68 million in revenue, with gross profit of around roughly $18.5 million. However, the company is still deep in the red, with operating losses of around $108 million and net losses of about $124 million. That translates to an earnings per share of negative 66 cents. After a strong ramp from 2022 through 2024, revenue has pulled back a bit this year. That's because Navitas is transitioning from fast-charging consumer electronics, where sales cycles were short, into a much larger programs in AI infrastructure, electric vehicles, and industrial systems, which take longer to qualify and scale. For now, operating losses remain heavy as the company continues to fund research, development, and the go-to-market efforts against a relatively small revenue base. Now, let's talk about profitability and margins. Gross margins sit around 27%, which is decent for an early-stage chip maker, but operating and net margins are still deep in negative territory, roughly minus 160% and minus 180% respectively. To improve margins, Navitas will need to ramp up production, especially on the GaN chips on 200mm wafers and the SiC modules, while shifting its product mix towards higher-priced data centers and EV solutions. As scale increases, manufacturing efficiency and volume should help push those numbers upward. On the balance sheet side, Navitas looks strong. They hold around $449 million in total assets and only about $60 million in liabilities. Their debt-to-equity ratio is nearly zero, just 0.02, which means very low leverage. They also maintain a current ratio above 4, signaling strong liquidity. With about $161 million in cash and equivalents and only $7 million in total debt, Navitas sits on a net cash position of roughly $154 million. That gives them several years of operational runway, even if cash flow stays negative, a big advantage over the peers that are more debt-heavy. Because EBITDA and earnings are still negative, traditional valuation ratios like P/E and EV and EBITDA don't apply here. That means investors are primarily valuing the stock based on future growth potential and margin expansion, not current profitability. So what does this all mean? Navitas is a classic high-growth, high-risk semiconductor story. The technology is cutting edge, the balance sheet is strong, but the company is still unprofitable. Their cash reserves give them time to execute and scale, but the stock's current price already reflects a lot of optimism about what comes next. For long-term investors who believe that wide bandgap semiconductors will be essential for AI data centers, EVs, and renewable energy, Navitas offers a pure play opportunity, but it comes with a meaningful execution risk attached. Now, let's talk about growth and where Navitas could be heading in the years ahead. Starting with the industry landscape. The global wide bandgap semiconductor market, which includes both gallium nitride and silicon carbide, is expected to surpass $20 billion by 2030, growing at an incredible 30 to 35% compound annual rate. These materials are key to unlocking higher efficiency and lower power loss across EVs and AI data centers and renewable energy systems. Within this booming market, Navitas holds a clear early mover advantage. It's one of the few companies offering both integrated GaN power ICs and automotive-grade SiC modules, positioning it across multiple high-growth sectors. The company estimates its total addressable market at over $13 billion by 2026, spanning AI infrastructure, fast charging, electric vehicles, and solar energy applications. Now, let's look at the tailwinds driving that growth. First, the AI infrastructure build-out. The explosion of AI data centers is fueling demand for ultra-efficient 800-volt power systems. GaN and SiC devices from Navitas help deliver faster switching, smaller form factors, and lower heat, all crucial for energy efficiency in GPU-dense environments. Next is electric vehicle adoption. As governments and automakers accelerate the shift to EVs, Navitas GeneSiC MOSFETs and diodes improve inverter performance and extend range, making EVs more efficient and cost-effective. Then there's the energy transition. With tighter global carbon targets, industries everywhere are seeking hardware that can reduce energy waste. Navitas' solution can cut power losses by up to 40%, directly supporting global decarbonization efforts. And finally, onshoring and supply chain realignment. With the U.S. CHIPS and Science Act pushing for domestic semiconductor production, specialized players like Navitas stand to benefit from the U.S.-based partnerships and incentives. Company-specific growth drivers are equally compelling. They've expanded from GaN fast chargers into SiC automotive and industrial modules, opening the door to much larger markets. Their AI power systems are now being tested in GPU cluster power supplies designed for NVIDIA and AMD-based racks, tying Navitas directly to the AI hardware boom. Strategic acquisitions like the purchase of the GeneSiC semiconductors and their added SiC capability for EV and grid-level applications are very big. Partnerships with top OEMs, including Dell and Lenovo, continue to boost brand credibility and customer reach. And ongoing manufacturing investments are focused on driving efficiency and lowering per-unit costs as production scales up. But there are still key risks. Execution remains central to the Navitas story. Competition is intense, with established giants like Infineon, Wolfspeed, ON Semiconductor, and STM Microelectronics holding scale and customer advantages. Profitability remains a challenge if growth slows or capital markets tighten. Continued losses could become a concern. Manufacturing GaN and SiC chips is complex, and yield issues can quickly erode margins. And finally, the valuation risk. At these elevated multiples, any growth miss could trigger a sharp sell-off. So, what's the bottom line? Navitas sits right at the intersection of three megatrends: AI computing, electric mobility, and clean energy infrastructure. Its dual focus on GaN and SiC gives it a unique bridge between low-voltage consumer tech and high-voltage industrial systems. With a solid cash position and expanding product line, the company has the runway to scale, but now must translate that technical leadership into sustained, profitable growth. For long-term investors who believe in an electrified future, Navitas represents a pure efficiency play, riding one of the most powerful technological transitions of the decade. Now, let's take a look at insider and institutional activity, one of the most revealing parts of any company analysis, starting with insiders. In May of 2025, Navitas' CEO Eugene Sheridan sold roughly 2.16 million shares at about $4.49 per share, netting close to $9.7 million. Other senior officers and directors also sold meaningful blocks. For example, one director sold about 162,000 shares between $4.57 and $4.66 per share, also in May. If we zoom out over the past 2 years, filings show that insiders collectively purchased around 18.5 million shares, worth roughly $164 million, while selling about 19 million shares, valued near $122 million. While insider buying has been strong historically, recent quarters have shown more selling than purchasing. Currently, individual insiders hold around 12 to 13% of the company, representing roughly 27 million shares, while institutions own just over 40% of the float. Some reports even estimate that total inside ownership could be as high as 30%, depending on how options and restricted shares are counted. That's a significant level of insider alignment, generally a good thing for investors, but the recent wave of selling does raise questions about the management sentiment or potential personal liquidity needs. On the institutional side, ownership remains solid. Large holders include BlackRock, Vanguard Group, and Capricorn Investment Group, among others. In total, institutions control roughly 45 to 46% of outstanding shares. That kind of presence usually signals a degree of institutional confidence in the long-term growth story, but it also introduces risk. In smaller, more volatile companies like Navitas, if institutions start rotating out, stock swings can be amplified very quickly. As for capital actions, there haven't been any major share buyback programs announced recently. Instead, Navitas has opened or opted for equity raises to help fund its growth and expansion plans. Some of the insider selling may also reflect option exercises, not just profit taking, but even so, it's clear that several executives are monetizing at least part of their positions. So, how should investors interpret this? On the positive side, high insider and institutional ownership means the management has skin in the game, and professional investors are paying attention. But on the caution side, the magnitude of insider selling, especially in recent months, is worth watching closely. Ultimately, insider behavior doesn't automatically predict stock performance, but it can hint at sentiment behind the scenes. Keep an eye on upcoming insider filings and institutional 13F reports. Sustained insider buying or new institutional inflows could reinforce confidence, while large exits from either camp might signal shifting expectations ahead. Let's take a look at the competitive landscape and where Navitas stands in the broader semiconductor landscape. Because competition here is fierce and understanding of players helps explain opportunity and risk, Navitas operates in a wide bandgap semiconductor market focused on gallium nitride and silicon carbide power devices. This is the new frontier of semiconductor technology, materials designed to replace traditional silicon with faster, more efficient, and cooler running chips. Here's a snapshot of some of the key competitors in this space. Wolfspeed, ticker Wolf, specializing in SiC power semiconductors with a market cap of around $2.8 billion. On Semiconductor, ticker ON, a major player in SiC-based EV and industrial chips valued around $37 billion. Infineon Technologies, ticker IFNNY, one of the biggest names in power electronics, worth roughly $56 billion. There's ST Microelectronics, ticker STM, another global leader in SiC and automotive electronics with a $45 billion market cap. Power Integrations, ticker POWI, focusing mainly on high voltage silicon-based ICs, valued near $5 billion. Transform, ticker TGAN, a smaller GaN-focused company worth around $150 million. And finally, Navitas Semiconductors, which is sitting at a market cap of around $3.3 billion. So how does Navitas stack up? First, integration advantage. Navitas is the first company to integrate power, drive, control, and protection all into a single GaN power IC. This all-in-one approach dramatically reduces component count, board size, and energy loss, giving it a unique design edge. Second is dual material flexibility. While most competitors specialize in either GaN or SiC, Navitas works in both. That means it can serve low voltage consumer electronics, mid voltage industrial equipment, and high voltage EV and data center systems, a versatility few others can match. Third is capital efficiency. Navitas follows a fabless model, outsourcing its chip production. That allows it to funnel more money into research, design, and partnerships rather than expensive manufacturing facilities. The trade-off? Less control over fabrication and potentially slower scale-up compared to vertically integrated rivals. Fourth is innovation velocity. The company moves fast. Its GaNFast chips were followed by newer lines like GaNSlim and GaNSense, targeting high-density power systems, the kind used in AI server racks and EV fast chargers. And finally, brand positioning. While giants like Infineon and ST Micro have massive scale and deep OEM relationships, Navitas has built its identity around a pure-play sustainability, appealing to investors and partners looking to bet on the electrification and energy efficiency megatrend. Now, let's quickly compare the numbers. While we look at the valuation metrics like price to sales and price to book, Navitas trades at a PS ratio of nearly 46 and a PB ratio of around 2.4, much higher than peers like Wolfspeed On Semiconductor or STMicro. Revenue is actually down 20% year over year, while larger competitors are posting modest growth between 4 to 7%. So investors are clearly pricing Navitas as a high-growth tech innovator, not a mature chip manufacturer. That valuation only makes sense if GaN and SiC markets accelerate sharply, and if Navitas can scale profitability. In summary, Navitas occupies a unique niche within the wide bandgap ecosystem. Its fabless and integration-driven model minimize capital intensity, but also more exposed to supply chain and manufacturing risks. If Navitas can successfully ramp production and expand partnerships, especially in AI data centers and EV platforms, it has the potential to become a high-margin specialty chip maker, much like early-stage power integrations or monolithic power systems. But if execution slips or larger players tighten their grip, Navitas could find itself squeezed out in a market rapidly consolidating under industrial gains. Let's wrap things up with a quick look at the technical setup for Navitas Semiconductor stock. Right now, the stock is trading well above its 50-day and 200-day moving averages, confirming a sustained uptrend. The 50-day average sits around $7.99, while the 200-day average is roughly $5.09. That configuration, where the shorter-term average is above the longer-term one, is known as the golden cross, and it's one of the most reliable signals of bullish momentum. The RSI, or Relative Strength Index, is sitting at about 63, which means momentum is strong but not overbought. In plain English, that suggests there's still room for the rally to continue, as long as buyers keep defending key support levels. Speaking of support, the first zone to watch is between $13.06 and $13.86. If the price dips below that, the next deeper level sits near $12.10. On the flip side, resistance, or levels where sellers may start taking profits, clusters around 1562, 1658, and 1738. A decisive breakout and a hold above that zone could reopen the path to previous highs, potentially setting up another strong leg upward. In terms of volatility and sentiment, momentum remains positive, price is comfortably above its major averages, and the RSI in the mid-60s indicates buyers are still in control. But make no mistake, this is a volatile stock. Trading volume is heavy, and after a run this strong, sharp swings in either direction are pretty common. The key levels to watch are simple. Can Navitas hold the support band in the low 13s on any pullback? And can it push through resistance between 15 and 17 with strong volume? If those conditions hold, the chart remains constructively bullish, supporting the idea that investors are still betting on long-term strength in the company's story. Now, no analysis would be complete without a look at the risks, because while Navitas has huge upside potential, there are also very real challenges that investors need to understand. First, industry and market risks. The wide bandgap semiconductor market, covering both GaN and SiC, is growing fast, but it is also highly cyclical. Demand depends heavily on AI data centers, electric vehicle production, and renewable energy expansion, all of which are tied to capital spending cycles. If there's a slowdown in AI infrastructure buildouts or EV adoption, Navitas' revenue trajectory, currently around $68 million, trailing 12 months, could take a hit. Second is operational and execution risks. Navitas is still unprofitable, with operating losses of about $109 million and net losses north of $124 million. The company is transitioning from simple consumer fast chargers into more demanding markets like AI servers and automotive systems, and that brings major engineering and supply chain complexity. If there are issues like low manufacturing yields on 200mm GaN wafers or delays in SiC qualifications, growth could stall, and already thin gross margins around 27% could come under more pressure. Third, financial and liquidity risks. Now, Navitas does have a solid cash position, about $161 million in cash, with only $7 million in total debt. That means they hold roughly $154 million in net cash, and a current ratio above 8 to 1, giving them a good operational runway. But here's the catch. The company still burns cash through R&D and expansion. If profitability takes longer than expected, Navitas may need to raise more capital, and that means potential dilution for shareholders, especially after a 400% stock rally in the past year. Fourth, competitive and technological risks. Navitas is up against some of the biggest names in the semiconductor industry. Infineon, ON Semiconductor, Wolfspeed, and ST Microelectronics. These giants have deeper pockets and established OEM relationships and a large-scale production capacity. While Navitas' combined GaN and SiC integration is a clear differentiator, competitors are quickly catching up through in-house R&D and acquisitions. If Navitas loses key design wins or has to cut pricing to stay competitive, it could squeeze the margins and slow revenue growth significantly. And finally, valuation and sentiment risks. At around 38 times price to sales and 40 times EV to sales, Navitas trades at extremely high multiples, far above industry averages. Those valuations assume near perfect execution, while short interest at roughly 26% of the float. The stock can swing hard in both directions based on quarterly results or market headlines. Any slowdown in AI-related demand, delays in customer adoption, or a broader rotation out of high-growth tech stocks could trigger sharp multiple compression. In short, Navitas is a high-potential but high-volatility story. Investors here are betting on flawless execution, accelerating adoption of GaN and SiC, and a future where power efficiency becomes a defining edge in everything from EVs to AI infrastructure. But even a small misstep could turn optimism into turbulence. Now, when it comes to the investment thesis and verdict, Navitas Semiconductor sits at the convergence of three massive technological megatrends: AI infrastructure, electric mobility, and clean energy. With its proprietary GaNFast and GaN SiC technologies, the company is positioned to capture a share in a wide bandgap power semiconductor market that's projected to exceed $20 billion by 2030. But as promising as that sounds, valuation remains demanding. Navitas trades at 45 times sales and is still not profitable. That means investors have already priced in a lot of growth. Over the next 12 to 24 months, we expect continued volatility as the stock moves between excitement around its technological potential and concerns about financial execution. For investors considering Navitas, this is not a short-term trade. The company fits best for those with a 12 to 36-month horizon, people willing to ride out short-term swings for exposure to the next generation of power electronics. On the bullish side, Navitas has a few major tailwinds working in its favor. First, AI-powered acceleration. The shift to 800-volt DC architectures in AI data centers, particularly those built around NVIDIA's hardware platforms, is creating a multi-billion-dollar opportunity for GaN and SiC power devices. Second, technology leadership. Navitas is the first mover in monolithic GaN IC integration, and one of the few companies offering both GaN and SiC product lines. That combination gives it end-to-end coverage from consumer devices to industrial and automotive power automotive power systems. A third is a clean balance sheet. With about $161 million in cash and only $7.4 million in total debt, Navitas has the financial flexibility to keep scaling manufacturing and expanding OEM relationships without taking on heavy leverage. Fourth is strategic tailwinds. The global shift towards electrification and renewables and AI infrastructure all depends on higher efficiency power delivery systems, and Navitas' chips sits directly at the center of that demand. Finally, partnership momentum. The company continues to gain visibility through AI-linked projects, especially in NVIDIA-based systems, along with new OEM engagements that could mark the start of a meaningful revenue inflection point. But the bear case deserves attention too. Execution risk remains one of the biggest concerns. Navitas is transitioning to 200mm GaN manufacturing and automotive-grade SiC production, both technically challenging and expensive. Any yield problems or qualification delays could stall profitability. Next, competition. Navitas faces industrial heavyweights like ON Semiconductor, Infineon, and ST Microelectronics. Companies with far greater resources, global supply chains, and established customer relationships. Gaining and holding market share against those names won't be easy. Then there's valuation compression. At roughly 45 times sales, Navitas is priced as if growth will continue flawlessly. If results disappoint or sentiment shifts, shares could see a sharp pullback. Dilution risk is also on the table because the company is still burning cash. Future equity raises could dilute shareholders. And finally, technology obsolescence. In an industry defined by constant innovation, rapid advances in silicon or next-generation GaN processes could narrow Navitas' current lead. Key catalysts to watch. There are a few important milestones investors should keep an eye on. The commercial rollout of Navitas' 800-volt DC power devices and early AI data center designs could be a big win. Volume production success for 200mm GaN wafers, along with improving gross margins. Quarterly revenue acceleration above $25 million per quarter, coupled with narrowing operating losses. New strategic partnerships or OEM adoptions in the EV and renewable energy sectors. And any insider or institutional buying, which would signal confidence in the company's execution path. As a monitoring checklist for any ongoing investors, here's what to track. Quarterly cash burn versus available liquidity, the trend in gross margins as production scales, OEM design win announcements and customer diversification, relative valuation versus peers like ON Semiconductors, ST Micro, and Wolfspeed, and finally, insider and institutional activity, whether money is flowing in or out. In terms of a final verdict, Navitas Semiconductor is a pioneer in energy-efficient power electronics with a clear technological edge, but it's still unproven from a profitability standpoint. The balance sheet is solid, the market opportunity is massive, and the technology is genuinely leading edge. But investors must recognize that the stock's current valuation already prices in a lot of success. For those seeking early exposure to AI infrastructure and electrification of global power systems, Navitas offers high upside potential, but it comes with equally high execution risk. In a verdict, a speculative buy. For long-term growth investors who understand the risks and are prepared to ride out meaningful volatility along the way, this could be a great stock. Thanks for watching this video. Hopefully you found it informative. If you did, consider hitting the like button and subscribing for more content. Make sure to also check out pinehold.com if you're interested in more deep dives like this.